Good afternoon. I got the slot right before lunch, so I'll try to keep it interesting. My name is Spencer Rich, and I'm a partner at Boosted AI. We are a machine learning platform for the institutional investment community. I was a former analyst and portfolio manager, predominantly on the fundamental side. So hopefully my talk today is going to focus on using AI and ML to empower the fundamental research process. And hopefully I can talk a little bit from personal experience, how we've been able to work with clients and personally seen a lot of this in action. Just a quick word on Boosted AI and what we're doing and how we're working with clients. We have a machine learning platform that brings our proprietary finance-specific machine learning algorithms to make them accessible to any investment strategy mandate, allowing you to bring your investment expertise, the data with which you want to evaluate your investments, your goals and your constraints to ultimately help you with better, smarter, more dynamic idea generation, all the way through to portfolio construction techniques. The core of our machine learning team came from Bloomberg. Our CEO, our CTO, head of our data science group, they were some of the core architects and founders of the machine learning group within Bloomberg. And it's interesting, being at Bloomberg, they were able to see what the broader investment community was doing around advanced quantitative techniques and machine learning. And the short answer is that there was actually very few firms that had the in-house capability, the teams in place, and even the desire to bring AI and ML in-house. That being said, there was an overwhelming interest in trying to see how can we start to implement this as a piece to our process. So the idea for Boosted was born over 5 years ago to provide this open architecture platform for firms to be able to use extremely sophisticated machine learning algorithms, but in a very accessible way. So today we have over 50 machine learning experts, data scientists, and finance professionals like myself who are bringing these cutting-edge machine learning algorithms to a whole variety of different clients. And I just show this screen to tell you just how diverse the clients are who are utilizing machine learning now. And even 5 years ago, I'd be shocked by how many of our different types of investors that we're currently working with. And it ranges from some of the largest financial institutions in the world all the way to startup funds. We work with hedge funds, long-only asset managers, insurance companies, family offices, pension funds, active index providers, those looking to launch new products. So the amount of folks that are now looking to bring ML and AI as part of their investment process, it's ubiquitous. The philosophy that we have at Boosted, and I think we've echoed this, we've heard this throughout a lot of the presentations, it's bringing the best of human and machine, right? Not meant to replace anything that you're doing in the fundamental process. There's things that humans are much better than at machines. There's things where you can understand a competitive landscape. You understand the macro context of something. You can drive the data that you want machines to learn from. You can sit across the table from a management team and read body language, right? But there's things that machines are much more efficient. And that's around synthesizing tremendous amounts of data, bringing patterns in that data. Sometimes they're intuitive and sometimes they're not, at a speed with which humans simply can't do. So the idea is to bring the machines in to understand your process, leverage your time to ultimately help you find new ideas, right? So it's the complement of the human plus machine is ultimately going to be the future of where investing is going. So why should you implement or think about implementing machine learning in a fundamental process or any investment process? A lot of the investors that we work with, they've been extremely successful. They've had successful funds that have lasted decades, and they've done a deep fundamental analysis. But they understand the changing landscape that we're now going through. We're going through one of the most unprecedented times in the financial history of what we've had. We're going through a period over the last 15 years, there's been 0 interest rates across the globe, no inflation. Asset prices everywhere have basically gone one way. And now that's all starting to get unwound. We're starting to see higher inflation. Central banks raising rates, right? Liquidity is being withdrawn. Layer on some geopolitical risk and war, and it's an extremely challenging environment to be an investment manager. So having a tool like machine learning and AI at your back. That's a forward-looking mechanism to take data that it's learning from in real time and being able to surface to you what's going on, what's changing, when there's regime shifts. Extremely important and powerful. And this comes to pattern recognition, right? That's what machines are good at. They can learn from these data sets and surface to you things that may not be intuitive. We as humans all have our biases, right? So having a systematic way to help us think about our investment universe is key. And this last piece around time to value. Having something that can work 24/7 at your disposal to have instantaneous results and analysis is also huge. Not only will it save your research team's time, but it hopefully will be able to provide results that you can see in real time as well. I think it's equally important that even if you have extremely sophisticated machine learning algorithms, they have to be implemented in a way that is easily accessible for anybody, right? So our job on our side is not to build one model, one algorithm, and then make recommendations across the entire investment universe and send those recommendations out. It's to understand what are your goals as an investment manager, what's your process, what's your mandate, and then help you build models, portfolios, et cetera, around those that fit your needs. And it has to be done in a way that's easy to use, right? These are extremely complex problems that we're working on, right? But if the average human cannot understand it, it becomes almost useless. So the way that we've designed our system is that you don't need to be a programmer, right? You can guide the system for what the data that you want to see, that you want to analyze, and have it be explainable AI. This is key. Explainable AI, right? Not only understanding all the inputs that can go into a model, but why is the machine making that decision? At a portfolio level, all the way down to a single security level. What's driving the thinking behind the machine? Then we can use it as humans. So generally speaking, this is how we frame the problem and the process of what we're doing. If you're running a portfolio, you're a research analyst, you can select the universe of securities that you care about. It could be a really broad-based index. It could be a global index. It could be very targeted for a specific sector. It could be for your own portfolio. Importantly, you can also select or test what's the data that you think drive your investments. It could be fundamental, it could be technical, it could be macroeconomic, it could be alternative data sets. You have the power for the machine, what the machine's going to learn from, and then what are your portfolio constraints and goals? Are you long only? Do you long short? Do you have position size limits? Do you have turnover limits? Are you trying to outperform a certain index, a total return? You want a certain Sharpe ratio. These are all things that you're trying to guide the system, right? And then you can select the proper algorithm to help you optimize that problem. And we break it down into a two-part problem, and we're going to focus mostly today on the first part, which is around idea generation, dynamic stock screening, the top of the research funnel, taking all those investments that you have the potential to invest in, and helping you sort and synthesize which are the ones that are most likely to outperform and why, and which are the ones that are most likely to underperform and why. Once we've done a good job of separating the winners from the losers and highlighting those reasons, we can then turn it into an optimized portfolio, helping with sizing, timing recommendations. Today we're going to focus on the top of the research funnel, how to create efficiencies in research, helping with dynamic stock screening and idea generation. And we'll go through, these are kind of some real-world exercises that we go through with our clients. Before we get into machine learning, this is kind of, when we think about traditional stock screens, this is the, I think, what most people that we come across do at their core. It is a rules-based screening methodology. I know that I've certainly employed this methodology throughout my 15-plus year career. In this example, if you see in the box, what we've done is we've taken all the different dots or potential securities that we can select from, and we have made a basic rule where we say we're only going to select stocks out of this 100 or so with earnings growth above 10% and a PE ratio under 20. Pretty simple rule, right? And we've carved out in the top left quadrant about 20 or so stocks that would fit that criteria. Okay, the green triangles represent stocks that actually ended up outperforming. So it did a pretty good job, right? We got about maybe 10 winners out of that list. The red are the underperformers, about 5, and 5 were neutral. Did a pretty good job. It's really easy. So some of the pros of this, it's easy to understand. It follows human intuition. It follows an investing logic that we can map, right? Okay. The problems, right, some of the cons against this is what everybody's doing, right? So if you have a strategy, a fundamental strategy, a lot of the same stocks are being flagged for everybody, okay? Number 2 is it's covering like 20% of your universe, but there's 80% of green triangles out there that are winners that you're not analyzing, that you're not looking at. And this is a static rule, right? So it doesn't change. So particularly now as we're going through this big regime shift, what's worked in the past may not work in the future, right? So having something that's going to be a little bit more dynamic, super important. So we want to have what's the next level approach. Okay, so this is how we think about machine learning. Try to have the brain invest like humans do. And what's that? Our algorithms emulate the human investing process. Okay, we compare every security in your universe against one another. We call our algorithm Battle Royale because that's what it's doing. It's essentially fighting every stock in your universe against one another to make a prediction which of those stocks are most likely to outperform based upon the data that we gave the machine to learn from with the goals that we are trying to achieve. Okay? So in this example, you have 4 stocks here, Apple, Google, Microsoft, Facebook. It's going to do a series of head-to-head battles where Apple versus Google, Apple versus Microsoft, Apple versus Facebook. The stocks that win the most head-to-head battles that are predicted to have the highest alpha return over your investment horizon from the data it learned from, they go to the top of the rankings. They become what we call our 5-star stocks. The stocks that lose the most battles, they go to the bottom. They become the 0-star stocks. So you get this dynamic relative value ranking every single time the machine relearns, recalibrates the data, and then does this series of head-to-head battles. You can see real time what it views to be the highest outperformers, right? So what are some benefits of this? Well, number 1, you can see there's many more opportunities that the machine has flagged when you're doing something that's not static and it's not particularly rule-based because you're allowing machine flexibility to find other opportunities that are out there. It's very understandable because you've given the data for the machine to learn from, so you know what the drivers are, and you can see why it's making its picks. It tends to be less volatile. The rankings actually tend to be pretty stable. It can adapt to regime shifts, so every time the machine relearns, rebalances, it can understand when data feature importance changes, highlight that to you, and it's excellent at finding subtle patterns. So this is key. We know that something may have worked in the past, but when you go through a different regime shift, you have to understand when things change, and that can surface to you instantaneously. So how does the process work? Super high level, like the blend of the human and the machine. Let's go through what's powered by you as the human. You select your stock universe that you want to analyze. You select the data inputs and the input features that you want the machine to learn from. And then the machine can learn from your inputs and then give you this point-in-time relative value ranking of the stocks that have used to be the outperformers from the underperformers. And then you as the analyst, the portfolio manager, can then take that rank listing and do your own fundamental work to see if you agree. And I just want to reiterate that this process is not intended to replace anything that a fundamental analyst investment manager is doing. It's another piece of information that's meant to be complementary. So they're still going to do their internal model building, their channel checks, their calls with management, their internal research reports. This is additional information, and we'll go through how you can use it. The first thing, and I think this is key, about selecting the data for the machine to learn from, this is where it gets to be extremely customizable. So the number of different permutations and combinations of data that you can use in a model is infinite. So here's some examples of data that we have on our platform that comes with our platform. We have fundamental balance sheet, income statement data from the likes of S&P, Capital IQ, FactSet. We have macroeconomic data from the Fed. We have option volatility data. We have ESG data. If there's any data sets we don't have, you can incorporate your alternative data. So this is where you can really drive the process. You can do a lot of testing. What are the data sets that you care about for the machine to learn from? From there, then the machine can provide a quant lens into what are the most important and predictive features for performance for your model within your constraints and your goals. And this is constantly learning, updating, and changing. So what you'll see is you see this word cloud on the left, and on the right you'll see an importance score. So this is not like linear regression or multi-factor model where you have to come in and you have to say analyst expectations, they're 6% of my model, and they're always viewed positively, right? Or they're always viewed negatively. It's much more nuanced. Number one is you can see with the word cloud, it's more contextual. It's analyzing all the data together to figure out patterns within the data. And then it's surfacing which of those data sets are in fact most predictive, most important, and most often used in the decision-making process. So this is sort of the first level of analysis at a portfolio level. The idea being then once it can sort and sift through all that data, it can do that on a unique basis, stock by stock. And as I talked about in terms of doing a relative value ranking of all the stocks in your universe, we bucket our stocks. So we bucket them into quantiles. The top quantile was this green line that you see in the bottom left. Okay, these would be the machine's top picks, what we call our 5-star picks. The red line would be the machine's lowest ranked stocks. And I think the biggest thing if you're a fundamental asset manager is just getting your head around that the technology can work for you. And it's not magic. This is not perfect. The best quant models may be right 55% of the time, right? Probably so are humans, but the best quant models may be right 55% of the time. But it's looking at the performance when it is right that it can deliver hundreds of basis points of alpha to your portfolio. So think about it like the casino. Like you want more hits at bat. You want that information to be able to use when you're making your decision-making process. And part of it is just analyzing these results to start to see that the machine is actually doing what it's supposed to be doing, separating the winners from the losers, and then be able to track this performance over time. Then it becomes equally important, once you understand that the technology is working, understanding why. It's great that it's working, but if you can't understand it, it's really hard to put in practice. So you'd be able to zoom in stock by stock. We just have some examples here of a few stocks at the bottom. But you can zoom in any one particular stock, and you can see of the data that you gave the machine to learn from, which were the actual most positive drivers of performance for that data on a forward-looking perspective. In this example, you can see something like net cash flow to enterprise value, currently in the 100th percentile, the highest it's ever been. The machine's viewing that as a very positive indicator for this stock. Whereas something like gross margin, which is in the 14th percentile, the low end of where it's been, it's slightly detracting from this ranking. And you can get an overall explain score, which sums all the positive drivers and all the negative drivers. So all the data in the word cloud would actually get scored, plus minus. And stocks that were viewed positively, they'd be at the top with the 5-star, have a very high explain score, very positive. Stocks that were ranked the lowest, most likely to underperform, they'd be at the bottom list as a 0-star stock, and they'd have a very negative explain score. And each stock would have a completely different set of variables and scores. So you, as a human, can come in and understand the machine's thinking on what is driving the performance. Then to be able to make this a little bit more understandable, you can have a point-in-time universe, right? What are the top 10 stocks in your universe? What are the bottom 10 stocks in your universe? What are the biggest movers ever up? What's moved the most from the last time the machine retrained, rebalanced? What's moved down the most? And then being able to see how good was the machine at making these picks. In this example model, you can see in the top right, when the machine had a strong buy recommendation, the 5-star stock, the average return here was just under 15% versus the benchmark of just under 10%. So being able to deliver 500 basis points of alpha when it's making a strong buy recommendation. Similarly, you can see on the sell recommendations, on the lowest ranked stocks, they underperformed the benchmark. So again, just seeing that the technology can work. In terms of some of the ways that we're seeing our clients get the most value out of the AI machine learning technology and algorithms in their practice, first is about trade ideas, right? So again, not intending to replace anything that the fundamental team is doing, but being able to surface what's an idea that I should dive into. I have a huge universe of potentially 1,000 stocks I can invest in. Help me organize my research process. Which are the ones that are most likely to outperform, right? Surfacing new trade ideas. Inflection points. So this is key, and this is something going back to the beginning of what I talked about regime shifts. When you have changes in the data, changes in the landscape, being able to highlight to the analyst, hey, something's going on here that's different, and we think this stock is poised to either do really well or to have some trouble ahead. And it can be opportunities to add new names to a portfolio or rebalance a portfolio accordingly. Providing explainable AI, providing insights into data, right, as that changes at a speed with which it's almost impossible for a human to do, and provide that quant lens to your fundamental team. So much of the market is driven by quantitative trading, and it's great to have that quantitative lens, even if you're a fundamental investor, to know what's going on in the market. And lastly, this is where the blend of the human plus machine comes in, is adding conviction, right? Not replacing, but adding conviction to what you are doing, right? So to be another check in your process. And that when you and the machine agree, hopefully giving you a little bit added incentive to be able to put that position on or to size a position up. So we're working with our clients across a lot of different use cases, and these are some of the most popular use cases that we've seen in the investment management industry. Today we talked a lot about the first one, the dynamic stock screening and idea generation, but I'll just highlight a few others that are particularly, I think, impactful. Portfolio optimization. Once that you've done a good job of picking those winners, staying away from the losers, you have an actual portfolio, helping clients with sizing and timing recommendations for a variety of optimization goals they have, helping clients hedge, right? So figuring out, is there stock risk that you have? Is there certain exposure risk that you have? Using AI to move beyond just correlation analysis to do price similarity, data similarity, to come up with the optimal hedging baskets, giving a lot of risk frameworks around factor analysis. What factors are driving your portfolio? Not just the traditional risk factors like momentum and value, but machine learned factors that go beyond this, and then helping our clients can control for those risk factors in their portfolios. Helping evaluate alternative data sets. You know, we've talked this morning, I've heard data, right? There's so much data out there. So which data sets are actually predictive? Which are actually important for your universe? Having an engine to be able to test that quickly, easily, for you to understand. And lastly, about 25% of our clients are systematic or quantitative clients, and they're building models on our platform to trade without any human discretion, or using signals from those models as a part in their investment process. So with that, I know we have a couple minutes before lunch. I'd love to open it up if anybody has any questions.